Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us live from the market site in Times Square, New York City, we have Chris Englebert, founding partner and chief investment officer with Englebert Financial Advisors. Chris, it is great to have you. After 2 years, back at the market site in Times Square, it does feel like, I mean, we could see the traffic outside a little bit, kind of getting back to the old swing of things here. However, the markets, you think, might be very reflective of the 1980s, not the 2020s, which to me is kind of scary as a kid from the 90s. We don't want any of those 80s fashions coming back.
Well, we don't want the 80s fashions, but what we're trying to have our clients understand is that we're going back to the 1980s, and I don't mean Madonna and parachute pants, but what we mean is if you look at the decade of the 1980s, it was characterized by high energy prices, high inflation, and high oil prices, very similar to what we have right now. Now, one of the things is that the 1980s turned out to be a very good decade for investments, and I know the last couple of months has been very rocky, obviously, in 2022, but we see light at the end of the tunnel, and we think it's going to come in the form of small, mid-cap stocks finally having their day in the sun. You know, it's interesting. We keep talking about rising rates, but they're nothing even close to what they were in the 80s. I mean, they're still historically low, even at these levels. I get the jump from 3 to 4 to 5%. The velocity of those moves was a bit scary here, but it's not the rates that we saw in the 80s. No, absolutely not. And I'm trying to keep people positive and pumped up because from an interest rate standpoint, 2.5% on the 10-year is back to where we were in 2019. So yeah, we've had a dramatic rise in interest rates, and we're going to talk about in our last segment about what the bond market's doing. But again, there's a tremendous number of positives going into this new decade. And if you, again, draw similarities between what happened in the 80s. In the 1980s, there was a lot of M&A activity that came about because it was a lot cheaper for a company to buy something than to start out, building something from scratch. And that's obviously what happens during inflationary periods of time. Companies will look around and say, hey, it's $2 billion to build a new building, start a new division or whatever. If I buy this company for $1 billion, it's a lot cheaper in the long run to do. So that could be the surprise for 2022.
That is a great point that you made, and I have actually not heard that thesis much yet. So we'll have to keep track of that one. As a registered investment advisor, how are you talking to clients with the speed of rising rates, inflation, everything that's just happened over the past couple of years, from pandemic shock to now geopolitical shock? Oh, and by the way, we have midterms this year as well. There's just so much going on.
Yeah, and people can get into a negative rabbit hole right away, but we're trying to have them understand that, when you have global markets, you have more volatility. There's been numerous studies that have shown that, obviously what's going on over in Ukraine is bad, but when you look at global tensions, 6 months, 9 months, a year later, they don't really factor into the long-term rates of return for equities and for bonds. I know it's tough right now with the news beat, 24/7, but we're trying to have these discussions with clients like, hey, you got a game plan. We think there's some changes that have to be done. We think that people have to understand that we could be in an inflationary environment higher for longer. Now, a lot of people have freaked out because inflation's running, pick a number, 8, 9, 10%. We don't think you're going to see that kind of inflation going forward, but you could have a decade of 3.5% inflation, again, very similar to the 1980s.
You know what, Chris, we were talking behind the scenes here, and you mentioned that you have a webinar coming up specific to teachers, and a number of the teachers that you manage, I think it was 7 or 8 of them, are retiring this year. And then you think about inflation on top of that when you think, oh, okay, retirement funds are fixed somewhat. Tell us more about that webinar and what you're going to be covering specific for teachers.
Yeah, if you go to our website on April 19th, we're going to be doing 2 webinars for teachers. And one of the things that we're trying to educate teachers on is they get a lump sum when they walk out the door, and they have to invest that, roll that over, but they also get a defined benefit plan. And the defined benefit plan is fixed. And the problem with a fixed defined benefit plan, I mean, the good news is you get that money for the rest of your life. The bad news is that money stays the same for the rest of your life. So if you have inflation of 3-4%, you're going to see your purchasing power, not now, but 5 years, 10 years, 15 years from now, start to erode. So you really need to sit down with a financial professional and talk about how do I invest my other funds in order to beat that inflation.
Right, well, of course, people are living longer now, which is a good thing, but $1,000 today versus $1,000 20, 30 years from now is going to be something very different. And I think you kind of need a wake-up call when it comes to that.
Yeah, and I don't think people are understanding. I mean, the good news is many teachers can retire earlier. The bad news is they can retire earlier. Right now, the average actuarial assumption for a woman is 87 and for a man 86, and that always creates some chuckles. But you know, the people have to understand you could retire in your late 50s and have another 30 years.
It's another
to live.
lifetime.
Exactly. And so we don't think a lot of people are thinking long term for that, and the only place that you can really beat inflation is equities in the long term.
Right. And speaking of equities, let's take a look at the charts here. We'll start with the S&P 500. We had a rough January, had a rough February, but I can't believe we're saying it's the end of the quarter for 2022. Looks like March is a bit promising.
Yeah, we had a big bounce back in March. We were deeply oversold. There was a lot of negative sentiment out there. You know, it's again typical when you have global tensions that roil the markets, a lot of volatility. But if you look at historic PE ratios, they've actually came back down during that period of February and March. And then beginning in March, people got a lot more clarity from the Fed. We were waiting for that Fed meeting where the Fed chairman would tell us, here's what I'm going to do this year for interest rates. Once that meeting was over, you could see the market really improve as far as the S&P 500.
Because it puts some certainty
Yes.
back into the market. None of that guessing game. Let's talk about the Nasdaq 100. I mean, it really was a cluster of stocks. It's almost, we've been hearing as goes Apple, as goes the market. And we saw that with Nasdaq 100 performance.
Yeah, I mean, it was scary. The narrative in January, February is obviously long duration assets, i.e. growth stocks, don't do well in a rising interest rate environment. Well, you saw, I'm coming out and saying that the real bear market started in February of 2021. And I have to say that if you look underneath the hood of a lot of these NASDAQ stocks, they were down 50, 60, 70, 80%. And that low that they made in February could be the low for quite some time.
Let's talk about the Russell 2000. I feel like this is an index either you love it or you hate it. It's either performing well or it's not. How did it do for March in the first quarter?
Yeah, I mean, it had a rough quarter like the other equity indices, but we really think that if you look at the relative strength of small mid-cap stocks the last couple of weeks, they're showing signs of life. And again, our narrative is, if you go back to the 1980s, there was a decade in the 80s where small mid-cap stocks outperformed. And we think what's happening is we're coming off of this concentration in large cap growth. And the Nasdaq, as a matter of fact, has several small mid-cap indices that investors really need to take a look at because that could be the best performance this year. It only takes a little bit of money to move some of these indexes a lot.
How about oil? I guess the key question is the top end for 2022, but of course, that's really headline driven at this point.
Yeah, I think the top is, to be honest with you. I mean, we were calling for higher oil the last 2 years. It hit our mark. One of the things, I was at a big investment conference for oil about 5 years ago here in New York City, and one of the oil analysts got up and said, we are not seeing any war premium in oil at all. Well, guess what? We've got a war premium now, and the question is it 20 bucks, 30 bucks a barrel? We think it's probably at least $30 a barrel, and oil is that war premium. And so when that news begins to dissipate, investors could be surprised at how rapidly some of those prices come down.
And what about the 10-year? We keep talking about this yield spike to 2.5%. Explain to the audience why this is significant. Why is everyone kind of, their feathers are getting ruffled with this?
Well, obviously the Fed can only affect short-term interest rates. And are they behind the curve? We don't know, but they're going to be raising short-term interest rates. And there's a lot of narrative out there that, well, once they raise short-term interest rates, if long-term interest rates don't keep going up, we could have the dreaded inverted yield curve. Well, you need that yield curve to invert for a period of time before it really signifies a recession. We think we're nowhere near that at this point in time. And what we're saying is that, investors were caught off sides. This is literally the worst quarter in bond market history. Mm-hmm. So if you are a good investor looking for income, you're going to look through the rubble, and there's a lot of value out there in the fixed income space.
It always kind of comes back to the Fed, and the question is, just by raising rates, can it really control the type of inflation that we're seeing right now? There are so many underlying factors there. You have a war going on. We're still dealing with pandemic bottlenecks, which were existing prior to geopolitics. Is that enough to really tamper inflation?
Well, I think what the Fed's trying to do is obviously change market psychology overall, and I think that's what happened in March, where they said, here's what we're going to do, and then you had a relief rally from the equity markets. One of the things that happens is, people's perception of inflation, all of a sudden they see it everywhere, and they start to panic and say, well, gee, we got to buy stuff now versus buying stuff later. We think a lot of these problems start to get solved because, again, you basically shut down the economy. We never did that before. We're opening it up. It's fits and starts to get it going. We think by the back half of the year, you're going to have a lot more positive news.
Right. Well, Chris, I mean, how much liquidity can you continue to throw into the system? You know, I heard some things around people getting gas cards so they can afford gas. And I get the human reasoning behind it. But at some point, you have to let market forces allow the economy to fail. Recessions are part of the boom and bust cycle. We learned that in Econ 101. Just to continue to keep throwing liquidity at it, this is why we get these sharp moves, because once you remove that liquidity, it can be really challenging. I don't think the market movement is just predicated on inflation and just Ukraine headlines.
Right. No, you're absolutely right. And so one of the things that we say about liquidity is, everybody's like, well, gee, if the yield curve inverts, the Fed keeps raising interest rates, we're going to go into a recession. I'm like, well, look at corporate balance sheets and look at personal balance sheets of people. I mean, people have just seen their houses go up tremendously, a lot of equity out there. So again, to really get in a recession, you need a bad labor market and you need people that don't have any money to spend, and we don't have that right now.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.